Welcome to the Property Wealth Podcast. Today, we're diving into a topic that a lot of folks over 40 might be wrestling with: self-managing versus property management companies.
Yeah, it's such an important decision, right? I mean, managing your own properties can save you money, but it can also be a bit overwhelming at times.
Exactly. And on the flip side, hiring a property management company can take a lot off your plate, but you have to consider those costs too.
Right, and there are pros and cons to both sides. We're going to break that down today and hopefully help our listeners figure out what's best for their situation.
We'll also touch on some key factors to think about, like your time availability, the type of properties you own, and even your long-term goals.
And don't forget about the local market conditions, which can really influence your decision.
Yeah, that's a big one. So whether you're a seasoned investor or just starting out, we've got practical advice coming your way that's relatable and easy to understand.
It's all about making informed choices that align with your overall investment strategy.
All right, let's get into it. First up, let's explore the benefits of self-managing your properties.
You know, Sarah, when we talk about self-managing versus hiring property management companies, it's really crucial for those of us over 40 to think about this in the context of where we are in our lives.
Absolutely. It's like many people in this age group are starting to look at retirement timelines, right? They want to ensure that their investments are working for them, not against them.
Exactly. And with inflation constantly nipping at our heels, having solid, reliable income from rental properties can be a game changer. I mean, just think about it. If you're self-managing, you could be pocketing that entire rent check, but then you've got to weigh the time and effort involved.
Right, and it's not just about the money either. It's about peace of mind, isn't it? I've spoken to investors who've had to put in late nights just to fix a leaky faucet or deal with a tenant issue. That can be really exhausting when you're also juggling work and family responsibilities.
Yeah, and that emotional toll can add up. I remember talking to a guy named Tom who's in his late 40s. He was managing a couple of properties himself, and while he loved the idea of hands-on involvement, he found it really stressful, especially when unexpected repairs popped up.
That's so relatable. I think a lot of people underestimate the emotional side of financial security. It's not just about the numbers. It's about feeling secure in what you've built.
Right, and let's not forget the current economic trends. With market shifts happening, the value of properties can fluctuate quite a bit. Self-managing might seem appealing when the market is hot, but when things slow down, it can feel like you're carrying the weight of the world on your shoulders.
Exactly. I've heard stories of investors who thought they could handle everything themselves, and then the market took a downturn. Suddenly, they were scrambling to fill vacancies, and it just spiraled from there.
And that's when hiring a property management company can really shine. They have systems in place to handle vacancies efficiently, and they often have a wider network for finding tenants. It's like having a safety net when things get rocky.
And for those looking to pass down wealth to their family, it's essential to think about how those properties are managed. If you're self-managing, what happens if you're no longer able to handle it? Your family could inherit a headache instead of an asset.
Exactly. I know a couple, Jane and Mark, who started investing in their 30s and were very hands-on with their properties. But as they approached their 50s, they realized they wanted to spend more time with their grandkids. They transitioned to property management companies to ensure their legacy was solid and stress-free for their kids.
That's such a smart move. It's about being proactive, isn't it? Like thinking ahead to how your investments will continue to serve your family's needs in the future.
Totally. And with the wealth transfer that's happening now, many families are looking at real estate as a key part of that. But if the properties aren't managed well, that wealth can diminish quickly.
So true. And given the rising cost of living, it's more important than ever to have stable, reliable income sources. I think many people are realizing they can't just rely on traditional retirement plans anymore.
Exactly. And property can be a hedge against inflation too. If done right, your rental income can increase over time, helping to offset those rising living costs. But if you're self-managing, this requires even more time and attention to detail.
Yes, and I think that's where many people get stuck. They want to maximize their returns, but they don't consider the hidden costs of their time and energy.
Right, and let's face it, managing properties can be a full-time job in itself. If you're not careful, you could find yourself putting in more hours than you would at a regular job, just to keep things afloat.
Absolutely. And for those approaching retirement, that's a huge consideration. You want to enjoy those years, not be bogged down with property management woes.
So it really comes down to understanding your personal situation. What do you value more? Control over your properties or your time and peace of mind?
Exactly. And it's okay if your priorities shift over time. What worked for you 5 years ago might not work now, and that's perfectly normal.
And it's important to remember that there's no one-size-fits-all answer. Each investor has to assess their own capacity and goals.
Right. For some, self-management might be fulfilling, while for others, bringing in a property management team could alleviate stress and free up time for things that matter more, like family or hobbies.
Well said. And as we transition into discussing core strategies, let's keep in mind that understanding your own lifestyle, your future plans, and how you want to manage your investments is crucial for making the right choice.
Yes, there's so much to consider, and we're just scratching the surface here. Let's dig deeper into the actual strategies that can help you make the right decision for your situation.
So let's dive into the differences between self-managing your properties versus hiring a property management company. It's a big decision and can really impact your bottom line.
Absolutely, Mike. I think a lot of people get overwhelmed by the thought of managing everything themselves. What are the main things they should consider?
Well, first off, you have to think about your time. Self-managing requires a significant time commitment, answering tenant calls, handling maintenance issues, and all that. If you're working full-time or have other commitments, that can be tough.
Right, and that's where a property management company can really save the day, isn't it? But then there's the costs involved with that too.
Exactly. Typically, property management companies charge about 8 to 12% of the monthly rent. So let's take an example. If you're renting out a property for, say, $2,000 a month, you're looking at $160 to $240 going to management fees.
So for someone just starting out, that might feel like a lot, but it can also be worth it in terms of peace of mind.
Yes, and it really depends on your personal situation. If you have a large portfolio, that management cost can add up quickly. But if you're just starting and don't have a ton of properties, self-managing might actually be more beneficial financially.
So it's about weighing those costs against your time and effort. What about the skills? Do you think self-managing requires a certain level of expertise?
Definitely. You should be comfortable with basic maintenance tasks or at least have a reliable network of contractors. If a tenant calls you at midnight because the heater's out, you need to know how to address that or have someone on speed dial who can help.
Yeah, that's a good point. And it could be a learning experience too, right? Like, if you're willing to roll up your sleeves and learn, self-managing could be a great way to gain knowledge about your investment.
For sure, and that knowledge can pay off in the long run. You'll understand the ins and outs of your property, and that can help you make better decisions down the road.
Now, let's talk about some practical strategies for evaluating whether to self-manage or hire out. What do you think is the first step?
A good rule of thumb is the 1% rule. Basically, you want to ensure your monthly rent is at least 1% of the purchase price of the property. If you're buying a $200,000 home, you should aim for about $2,000 in rent.
That's a pretty straightforward way to gauge potential profitability. But if that's not happening, what does that say?
It could indicate that you're either overpaying for the property or that it's in a less desirable area. In that case, self-managing might be riskier, since high vacancy rates could lead to more headaches.
And if the numbers don't add up, that's when a property management company might be a better fit, right?
Exactly. They can help you maximize your rental income and handle things more efficiently.
What about the 50% rule? I've heard of that one too.
Ah, yes. The 50% rule is a quick way to estimate your operating expenses. You take your gross rental income and assume that about 50% will go towards operating expenses, including property management, maintenance, and vacancies.
So if you're making $2,000 a month, you'd budget about $1,000 for expenses, leaving you with $1,000 in cash flow?
Right, and of course that's a simplified version. Actual expenses can vary, but it's a helpful guideline.
Now let's talk about financing options. A lot of first-time investors wonder about the best way to finance their properties. What do you recommend?
A common option is conventional financing. You can often get a mortgage with as little as 3% down, depending on your credit. But if you're looking at multifamily properties, you might want to consider an FHA loan, which allows for lower down payments.
And what about the cash flow? That's essential to consider, right?
Absolutely. When you're evaluating a property, check the cap rate, which is the net operating income divided by the property value. For example, if the property generates $24,000 a year in income and costs $300,000, your cap rate is 8%.
That's a solid return. What's a good cap rate to aim for?
Generally, a cap rate of 8% or higher is considered good. But remember, it's all about your market. In some areas, a 6% cap rate might be standard and still be a worthwhile investment.
Got it. And I guess it really comes down to doing your homework, right?
Exactly. You need to analyze the local market, understand rental trends, and assess property types. Single-family homes might offer stability, while multifamily units can provide higher cash flow.
So many factors to consider. But once you have a property lined up, what's next in terms of management?
Well, whether you decide to manage it yourself or hire a company, you need a solid tenant screening process. This means checking credit, rental history, and income verification. You want tenants who will pay on time and take care of the property.
Definitely, and that can save a lot of trouble down the road.
You also want to have a clear lease agreement in place. Make sure it outlines everything from rent due dates to maintenance responsibilities.
That makes sense. Now let's talk about some common pitfalls people run into when making these decisions. What do you see most often?
One major pitfall is underestimating the time and effort involved in self-managing. Many new investors think it will be easy, but it can quickly turn into a full-time job if not managed properly.
Yeah, I can see that. And I imagine that leads to burnout pretty fast.
Exactly. And then there's the financial aspect. Sometimes investors focus too much on profit and forget to account for maintenance and vacant periods. You've got to be realistic about your cash flow projections.
Right. It's all about balance, isn't it?
It really is. Making informed decisions is key, whether you choose to self-manage or hire a property management company. So when we talk about self-managing versus using property management companies, one of the biggest pitfalls I see investors fall into is over-leveraging.
Oh, definitely. That's a big one. You know, they get excited about the potential returns, and before they know it, they're stretched too thin financially.
Right. I had a client, for example, who bought 3 properties in quick succession. They thought they could handle the mortgages, but once the market shifted, their rental income didn't cover the payments, and they ended up in a really tight spot.
That sounds stressful. I guess it's easy to get caught up in the numbers and forget about the reality of cash flow.
Exactly. Cash flow is king. If you're not keeping an eye on it, you can quickly find yourself in trouble. I mean, I've seen investors ignore cash flow projections because they were too focused on appreciation.
What happened there?
Well, there was one investor who bought a property without checking the rental market properly. They assumed the rent would cover the mortgage, but when they finally found tenants, they had to lower the rent significantly to attract anyone.
Ouch, that must have hurt.
Yeah, it did. They ended up carrying a negative cash flow for months, which can really drain your resources and morale.
So what's the lesson here? Always analyze rental markets before buying?
For sure. And also, don't just look at what the property could be worth in a few years. Focus on the cash flow it can generate right now, because that's what keeps you afloat.
And what about bad tenants? That seems like another common issue.
Oh, absolutely. Bad tenants can wreak havoc on your investment. I once had a colleague who rented to someone without doing a thorough background check.
What happened?
Well, they ended up with a tenant who didn't pay rent for 3 months. And when they finally did leave, the place was, let's just say it was in terrible shape.
That's awful.
Yeah, it's a nightmare scenario that could have been avoided with better tenant screening. It's essential to check references, credit history, and even past landlord experiences.
So what do you recommend for spotting potential red flags early?
Look for signs like inconsistent income or vague answers during interviews. If a potential tenant seems reluctant to provide references, that's a huge red flag.
And not just tenants, right? This also applies when you're considering a property management company?
Exactly. You want to vet your property manager just as thoroughly. I've seen people hire a property management company based solely on their fees. But, sometimes you get what you pay for.
Yes. I've heard horror stories about property managers who don't communicate, or worse, who don't handle repairs in a timely manner.
Right. I had a friend who hired a cheap management company. They neglected basic maintenance, and it led to bigger issues down the line.
Like what?
Oh, things like mold and plumbing issues, which not only cost more to fix, but also can drive away good tenants.
That sounds incredibly frustrating. So what's the solution?
Well, it starts with doing your homework. Check reviews, ask for references, and maybe even visit some of their properties to see how they're managed.
And sometimes people think timing the market is a good strategy, but it can be risky, right?
Yes, definitely. Trying to time the market can lead to missed opportunities. I had a client who waited for the perfect moment to buy. By the time they were ready, prices had already skyrocketed.
So it's better to focus on long-term trends rather than trying to predict short-term fluctuations?
Exactly. Real estate is a long game, buying with a plan for the future rather than waiting for the market to dip.
And hidden costs can really surprise new investors too, can't they?
Oh, for sure. Things like property taxes, insurance, maintenance costs, and even unexpected repairs can add up quickly. I once had a client who underestimated their maintenance budget, and they faced a huge bill after a storm damaged the roof.
Yikes! That's a tough lesson to learn.
It really is. That's why I always recommend building a contingency fund. Setting aside a percentage of your rental income for those unexpected expenses.
That's such a smart idea. It's like having a safety net.
Exactly. And it can make all the difference in keeping your investment stable.
So, to wrap this up, what would be your top advice for someone looking to avoid these pitfalls?
Well, first off, always do your due diligence. Research the market and vet your tenants and property managers thoroughly. Second, keep a close eye on cash flow and don't over-leverage. And lastly, prepare for the unexpected with a contingency fund.
Those are great takeaways, Mike. I think that grounding in practical advice really helps demystify the process.
Absolutely. Real estate investing can be incredibly rewarding, but it does require careful planning and a willingness to learn from mistakes.
And that's how you build long-term wealth, right?
Exactly. It's about being proactive and informed rather than reactive.
Well, that's a perfect segue into next steps for our listeners.
Yeah, they should take the time to evaluate their current strategies and maybe even reach out to an advisor if they're feeling unsure.
Great advice. Let's dive into that next.
So, if someone's feeling ready to dive into this whole self-managing versus using a property management company thing, where do they even start?
Yeah, it can feel a bit overwhelming at first, right? I mean, it's a big decision. But there are definitely some immediate steps people can take.
Absolutely. First off, I'd say get familiar with some tools. Apps like Zillow can be really handy for assessing property values and finding rental comps.
Right, and speaking of comps, Rentometer is another great tool. It helps you figure out what you should be charging for rent in your area.
Exactly. And if you're looking to analyze deals more deeply, the BiggerPockets calculator is a must-have. It allows you to run the numbers and see if a deal actually makes sense financially.
Oh, and don't forget about DealCheck. That one's super user-friendly for evaluating different investment properties.
Yes, and if someone has access to their local MLS, that can be invaluable. They can get the most accurate data on property listings and trends in their area.
Those tools really lay the groundwork. But what about habits? What should they start doing daily or weekly?
Good question. I'd suggest starting small. Maybe commit to analyzing one deal per week. Just pick a property, run the numbers, and see how it fits into your investment strategy.
That's manageable. And it'll help build your confidence over time.
Also, joining a local real estate meetup can be really beneficial. Meeting other investors can provide insights that you might not get on your own.
Plus, the networking aspect is huge. You never know when you might find a mentor or a partner in those settings.
Definitely. And for those who prefer learning at their own pace, there are some fantastic books out there. The book on rental property investing by Brandon Turner is a great read.
I love that one. It's really practical and straightforward. And what about podcasts? There are so many out there now.
For sure. The BiggerPockets podcast is a classic. They feature real investors sharing their experiences, which can be really inspiring.
Yeah, and it's like having a conversation with them, right? You feel connected and can learn so much from their journeys.
Exactly. Another good one is real estate investing for cash flow with Kevin Amolsh. He dives into strategies that can be really useful for both self-managers and those who go with property management companies.
Those sound like great resources. And I think on the habit front, it's also about mindset. Starting to think like an investor can really shift your approach.
Oh, absolutely. It's not just about the properties. It's about how you view opportunities.
So you might start by setting aside a bit of time each week to educate yourself, analyze deals, or even just reflect on your goals.
Right. And remember, it's all about progress, not perfection. You don't have to have everything figured out from day one.
Exactly. And as you get more comfortable, you can start exploring those property management companies if that feels like the right next step.
Yes, and keep in mind it's totally fine to switch gears if you find self-managing isn't your thing.
Absolutely. It's all about finding what works best for you and your lifestyle.
So, with all these tools and habits in place, listeners can really start taking actionable steps towards their real estate investing journey.
And it's exciting to think about the possibilities ahead. So let's recap what we've covered today.
So, as we wrap up today's discussion on self-managing versus using property management companies, there were some really important points to take away, right?
Absolutely, Mike. I think one of the biggest takeaways is that self-managing can save you money, but it does require a lot of time and effort.
Yeah, definitely. And if you're not comfortable dealing with tenants or repairs, that might be a sign to consider a property management company.
Right. And then there's the peace of mind factor. Knowing someone else is handling the day-to-day stuff can really free you up to focus on other investments or even just enjoy your life more.
Exactly. And we also talked about how, at the end of the day, it really depends on your personal situation, your goals, your availability, and what you're comfortable with.
And let's not forget the importance of doing your research. Finding a good property management company can make a huge difference in your investment experience.
For sure. It's all about making informed choices and setting yourself up for long-term success.
Building wealth through real estate isn't just about the properties themselves. It's about the strategy behind them and how you manage those assets over time.
That's right. So, to everyone listening, remember that whether you choose to self-manage or hire a company, be proactive, stay educated, and don't hesitate to reach out for help when you need it.
And we'd love to hear from you. If you found value in today's episode, please like and subscribe, and comment below with your biggest takeaway or any questions you might have.
And if you know someone over 40 who's thinking about investing in property, share this episode with them.
Yes, it could really make a difference for them.
Next time, we'll dive into the topic of how much property managers should charge, which is a crucial part of the decision-making process.
So don't miss it. Thanks for listening, everyone. We appreciate you being here with us.
Until next time, take care and happy investing.
Bye for now.